back to the SBS podcast. As always, I'm Coach Ryan. You can follow me on Instagram and YouTube at Ryan at Strategics. We're going to keep on building momentum. But today, I want to start with a question. If your income stopped tomorrow, what would happen to your family financially? Would the bills still get paid? Would the mortgage still get covered? Would there be enough time for your family to grieve without immediately worrying about money? Most people don't think about questions like that. But avoiding risk doesn't remove it. It just leaves you exposed to it. Today, I want to talk about something that many people delay until it's urgent. Life insurance. And before you tune me out, this isn't a sales pitch. I don't sell life insurance, but it's a stability conversation. Because if we're serious about building stronger financial lives, then we have to talk about risk. Every household has it. If the primary income earner passes away, what happens? If a parent dies unexpectedly, what happens? If debt still exists, what happens? Life insurance is not really about death. It's about risk tolerance. Risk tolerance simply means this. How much financial shock can your household absorb without collapsing? Because here's the truth, income is temporary. It only flows as long as you're alive and able, but responsibilities don't disappear just because income does. You still have a mortgage, your car note, student loans, your kids, everyday living expenses. Life insurance steps in when income stops. It creates financial breathing room in the middle of emotional chaos. And that matters because if grief is already heavy, financial chaos is not going to help the situation. Financial panic shouldn't be added to it. Now, when people start learning about life insurance, they usually hear about a few different types. And I'm going to give you a breakdown in simple terms. The first one is term life insurance. Term life insurance companies typically offer you a coverage for a period of time, typically 10, 20, or 30 years. If something happens to you during that period of time, then the policy pays your family the benefit. If the term ends and nothing happens, then the coverage simply expires. Term is usually the most affordable option and is often used to protect income during the years when families are raising children, paying off homes, or carrying the most financial responsibility. The second type is whole life insurance. Whole life insurance is permanent coverage. That means it lasts the entire life of you as long as the policy stays active. In addition to that death benefit, whole life policies build cash value over time. Some people use this type of coverage not just for protection, but also as long-term financial planning. It's more expensive than your term life, but a great tool. And another type that people are starting to hear about more often is indexed universal life, often called IULs. This is another form of permanent life insurance. It still includes the death benefit, but it also has a cash value component that can grow based on the performance in the market, like the S&P 500. It doesn't mean that your money is directly invested into the stock market, but the growth potential is linked to the index with certain limits. Different policies serve different purposes. The goal today isn't to debate which one is best. The goal is awareness. And there's another part of this conversation, though, that people tend to overlook. Many people have life insurance through their job, and that's a good thing. Employer-provided coverage is a valuable benefit. But in most cases, that coverage is tied to the job itself, meaning that if that job changes, the coverage usually changes too. If you leave the company, get laid off, or change employers, that policy oftentimes goes away. And that coverage amount is usually limited, sometimes only 2 or 3 times your annual salary. For many households, that may not be enough long-term coverage for responsibilities like mortgage, children's needs, and the years of lost income. So employer coverage is helpful, but it cannot and should not be the only layer of protection that you have. Think of it as a supplement, not as an entire safety net. Because your family's financial protection shouldn't depend entirely on where you work. It should depend on the plan that we build. And here's something important to understand. Protection increases confidence. When your foundation is protected, you think differently. All right, we'll be able to take more calculated risks. We can focus on building more long term, and we'll move with a little less anxiety, because you know that your family isn't one tragedy away from instability. This isn't about expecting something to happen, and we know it feels weird thinking about life insurance. That does not mean we're going to die, fam. Let's change the way we think about that. But what it is doing is us refusing to allow one event to erase everything we built. Strong financial lives are layered: stewardship, assets, reduced liabilities, and protection. No, it's not because we're paranoid. We're just focusing on being more prepared, because preparation creates stability, and stability creates freedom. So here's the question I want to leave you all with today. If your income stopped tomorrow, what would happen next? If that question makes you uncomfortable, that's not shame. That's awareness. And awareness is always the first step toward strength. Take a moment to think about your family's future. Men, we can teach all the lessons in the world that we want to our kids, but when we close our eyes, we don't want to only leave them with information. We want to leave them with a head start.
I'm feeling better than ever. Scratch that. Better than better. Only live once. Can't be me. I'm living forever. Turn up the bass. I stay out of trouble. I'm walking with God and stomp on the devil. I had to follow the plan when I did not understand. Now I just feel like the man. Watch how I'm doing my dance. Bigger than me with your brand. All that I need is a chance. I pray that we see promised land. I know that we can.